Welcome to the daily update, where I'll go over the action in the market for Tuesday, November 12th, and we'll see how things look for Wednesday, November 13th. We're still positive, but we're seeing some weakness in some of our primary indicators. We're dropping below zero with the S&P and NYSE McClellan oscillators, which are turning the summation indexes down just a little bit. Now we can get that back. We've dropped below it before and bounced back up. But we just want to be aware of this. We're also a little bit concerned about the Chaikin money flow. It's just not showing any strength right now. But when you look at things based on moving averages in the short, intermediate, long term, we're doing just fine. And we've had a big run up. We're still overbought in the short term, or that could be momentum. We saw things slow down to below average volume in Tuesday's session because we have CPI coming out on Wednesday, PPI on Thursday, and retail sales on Friday. Those are three big reports, and we'll have to see what the climate is like for those reports and how the market will react to that. Okay, there's a thing called the SPX Investing Program. It's a program I've developed, and it's up, it's going, it's free until the end of 2024. Please feel free to check that out. There are links that will take you to the website or to a video, and one benefit is you get early access to the videos as they are available. Also, the daily video is mainly what I focus on. All of the other videos around the outside, they're meant to tie into the daily video. Okay, let's go back and talk about what happened. We had a flat to slightly higher open, but right after that, prices declined down below the daily pivot at 6,002. So now we're dealing with that 6,000 level, but we dropped below it. We went to the unchanged level and to S1 at 59.86. Prices continued to decline and we fell down below S2. We actually hit a pivot point that I'll bring out not only with the S&P but with some other indexes. But S2 was at 59.71. Then we were able to rebound back above S2. We got up above S1. We hit resistance at the unchanged level and at the daily pivot, which, as I often mention, especially the unchanged level, it is a built-in resistance level when we're negative. It's a built-in support level when we're positive. Then prices drifted down and we closed at S1. We were down 0.29% on below average volume. As I said, we are still positive in the short, intermediate, and long term, but there are just some signs that we want to be aware of. We'll have to see if this euphoria that has been hitting the markets will continue. Will the FOMO, the fear of missing out, continue to come into the market, or is that pretty much over now? We'll evaluate things if we start to go down and say, okay, what weakness areas are we starting to see? Or the concerns that we have right now, will they get dealt with if we go back up? Wednesday will be about inflation with CPI coming out, and that will give some guidance to interest rates, which are going back up now with the 10-year yield, and that puts some pressure on stocks. We also have the dollar really going up as well. And we want to keep an eye on the geopolitical concerns. And then if there's any kind of a fallout with the US election that really hasn't developed yet, there's probably going to be more in the Middle East. It's just a matter of when, not if. But there's still some concerns that after the election, there could be some upheaval over that might have an impact on the markets. So, are we still dealing with FOMO, the fear of missing out at this point? Now, after the election, we're kind of beyond that now. And with the market slowing down a little bit, both Monday and Tuesday were not really big days as far as the market continuing to go up. So we may be coming past that period of time. And we want to keep an eye on the Middle East. Oil's down around the 68 level, not really shooting up at least yet, but that could change. And if we go up for those reasons, that could pressure stocks as well. A little bit shorter with our list here. We still have the VIX that has gone down pretty far, pretty fast. And I use an RSI 9 to measure that. The rate of change going back 5 periods, that'll fall off at some point if we continue to go sideways or even down, but it's still looking extreme positive. And then our usual indicators that we have here. The Stochk RSI, the Williams percent R, CCI 14 and 20, the stochastics, and we're still kind of far away from that 20 period moving average, even though we're coming back a little bit closer to it. Intermediate term, we still have the CMB composite. It's coming down, but still extreme. Standard deviation, we're still in that +3 channel, which can be extreme, positive. And then the Arun indicator, it was extreme and it's really dropped. And I kept it on the list here. We don't see that chart. It seems to not react. And then when it does, sometimes it can be a big reaction. The Sean trend meter, not really extreme, coming down just a little bit. And we're still far away from the 50 period moving average, even though we're moving closer. We're still looking either good or a little extreme with our 150 and 200 period simple moving averages. And no change to the scenario. We'll see if anything changes with CPI, PPI, and retail sales coming out, but the market is anticipating a soft landing. It seems like they're still stuck on that scenario, and the Fed is in the process of cutting rates. And that's what they did last week. The dollar was up and interest rates were actually up. This should be changed from close to up. We're at 4.43%. That's a big jump where we had been at 4.31%. So we're kind of bumping up to that 4.5%, which is a lot higher than most folks had been expecting here. We're still inverted with the 10 to the 3-month yield curve. We're uninverted with the 10 to the 2. That hasn't changed. We're getting a little closer to becoming uninverted or going back to normal with the 10 to the 3-month, but it's not there yet. We're still positive with sentiment. It actually ticked up a notch, even though we were down slightly. We had been at 68, we're at 69. 75 is that level where we start to get extreme with sentiment. We are positive with the trend, and we're above the moving average. So that suggests a strengthening trend, and the green line is above the red line. We're above 20, so that's a trending environment. And usually with the bias, if we have an up day or a down day, it's either positive or negative. I kept it at mixed because there were some positive things that happened in the market, but there was also some selling that took place. But still, the last 2, 3, 4, 5 days taken together, the momentum continues to be positive there. We just had the NFIB Small Business Optimism Survey. It ticked up. It came in at 93.7, or the last time we had the reading, it was 91.5. And then this isn't technically an economic report that comes out, but there's a survey of consumer expectations, and it didn't really have much of an impact on the stock market, but it showed that a year ahead, inflation, it's now at 2.9%, what people are expecting, where it had been at 3%. 3 years out, it's at 2.5%, where it had been at 2.7%. Looking out 5 years, 2.8%, where it came down from 2.9%. Okay, here is really the only chart to show the NFIB Business Optimism Index. Still looking a little more positive here. We're seeing it coming up after it had been lower than this in previous months. And looking at the overbought, oversold composite, we're getting pretty high now. We're into the 90 range, and this could suggest that the market is overextended to the upside. This takes a lot of the things that we look at, but this is a weekly chart here where I look at the short, intermediate, and long term and kind of put it all together myself. This tries to take things and put them into an overbought or oversold reading, and it's getting pretty extreme right now. And then here's one of these crazy charts. It says big gains at all-time highs tend to be bullish. Not an excellent track record, but still respectable nonetheless. And you can see the green diamonds here, that when we hit all-time highs and then gains after that. And this is fuzzy because I have to blow it up like 400% just so we can see it. But looking out 1 month, we're up 58.3% of the time. 3 months, 66.7. And going out 6 months and 12 months, we're about 79.2 and 78.3. So not like a perfect 100% track record, but things tend to be more positive than negative. That all-time highs tend to lead to more new all-time highs. The equity positioning right now is going up. We're seeing folks jumping back in here. That's above zero and climbing. And this is kind of going against what we're seeing right now, where we're not at 4.32%. We're at over 4.4% now. The futures market thinks that interest rates are going to be going up, and that's what I'm seeing here, where Goldman Sachs thinks, oh no, we're going to go down to 3.85%. So there's a real disconnect here on this forecast. Money market funds, just a lot of money going into that right now. Some of this does not go into the stock market. Folks like money markets because they're still giving a better return than just putting money in a bank account. And then looking at valuations, and these are PE ratios where we have the US, we're at 22.6. And I deal with this in the weekly video, the intermarket analysis video. And it's the most expensive stock market on the planet right now, but it's also the best performing market as well. But at some point, the market may want to deal with this. Then this is looking out forward, and we're well above that 20 level. We usually use the 10, 15, 20 scale with this. In other countries, like the whole world, it's still under that 20 level. They have another world index at 18.4. You've got, and then emerging markets in Europe and all that. But the one that we focus on the most here is what happens with the US. And then the S&P has also seen its strongest year-to-date performance of the 21st century. Yes, we're a whole 24 years into this, starting the 25th year here soon. This is the whole spaghetti mess of what's been happening, and they benchmark it back to 100. And then the blue is where we're at. And since we're peeking our head out of the top here, that means that we're performing the best at this point in the year so far in the 2000s. Then the S&P's weekly gain was the strongest of 2024 so far, and it's the biggest post-election gain that we've ever seen. There was some relief that the election was pretty clear. You know, they kept saying it's going to be, coin toss, 50-50. Well, it ended up not being all that close, and the market was really relieved over that. So we're seeing a lot of good performance from there as well. Multiples have gotten in front of a rebound in earnings revisions. When we see this blue line going above the yellow line, this is the price year over year. That means the price is outperforming earnings revision. And it tends to be more positive when we see the yellow line above the blue line. And we're seeing it really kind of far apart here. Now, at some point, the market may decide to deal with this, but this can last for an extended period of time. Looked at Twitter, but didn't really see anything all that interesting. And this chart actually was posted at Isabel Net, but it's a Yardeni chart, so I put it under here. And he's coming out with the idea that of course, you can come up with any number you want. I think the S&P is going to be at 15,000 by 2035. I mean, my goodness. But folks like forecasts. I don't do that. I just look at things where how they are right now. We look at the evidence, we reach a consensus and say, okay, the probability is that we're looking positive right now. But folks love the idea of forecasts. Even if they're wrong 80, 90% of the time, they still like this idea that things are going to go up or things are going to go down based on whatever conclusion they reach. But this is Edward Yardeni, somebody I've read his books and somebody I respect. I follow his website, and he thinks that we're going to get to 10,000. Okay, fine. But let's come back in 2030 and just see how close that was. We might go above that. We might not even get anywhere close to it. There's so many variables that could come into play with this. All right, here is the chart, and it's looking rather flat because we're seeing this huge run up here. And then Monday's session was pretty muted, so that made the pivot points pretty close to each other for Tuesday's session. We did try to creep up a little bit, but we set the high right after the open, and that's kind of what we saw in Monday's session. Not a lot of strength going into the close. Now, we did see a little bit of a rebound later in Tuesday, but we initially came down, fell below S1, even fell below S2. This is not on this chart, but we did hit a pivot point here and as well as on other indexes. And then this is encouraging here. We did see some buying coming back in that took us back above S1, S2, S1. Didn't quite get to the unchanged level again here, and then just kind of drifted down and closed slightly below S1. And we're pretty muted right now as far as the initial overnight session, seeing a little bit of a drop off here. And we were pretty muted before we got into the cash session here, but we set the high in Tuesday's session really right after the open. We saw a nice little bounce coming up here, and then the drop off during the day. And this is still positive. We see the blue line above the red line intraday large cap growth is outperforming large cap value. And this is also looking pretty good. If you go back, get a little context, go back to about Halloween, and we are seeing an overall advance when we look at S&P growth to value. So that's still positive there. End of day, we were up with growth where value ended up being down. We were down less with the mid caps and down, but down less with the small cap growth. But we're still seeing an overall improvement here with small cap growth to value, although we're still in a downtrend. Also an improvement with mid cap growth to value, but we're still in a downtrend and not really breaking out, but holding up and still in an uptrend when we look at S&P growth to value. So this is still positive here. And we're coming a little up more out of the rainbow now when we look at the growth versus value ETF. So growth is holding up for right now, and that's positive. Still seeing that we're hanging on to gains here when we look at discretionary to staples and take a ratio. This has been one of the stronger areas of the market lately, and that's positive also. Our trend is still positive. We are rolling over a bit with the green line. We were getting a little bit concerned that we were getting too close to 40. But in Tuesday's session, we saw the green line coming down, the red line coming up. We're also a little concerned that the red line was dropping below 20, but we are still trending here. We're still above the moving average and the ADX is going up. So it's a positive strengthening trend for right now. In the short term, also seeing the green line coming down after getting pretty extreme. The red line's coming up. We're also in a short-term trend since we're above the moving average. We did drop to below average with volume, but we've been seeing volume pretty healthy. Now, the expectation is that for the rest of the week, volume should pick up and be above average because of the major economic reports that'll be coming out. Sentiment, we're still dropping off here with the VIX. We're coming down there with the line chart and the bar chart. Even though we had a slight down day, the VIX is coming down to more normal levels than what we've seen earlier in the year. And we also came down just a little bit here with the VIX of the VIX. When the VIX goes down, typically the VIX of the VIX also goes down. We're still getting extreme here with the VIX dropping pretty far, pretty fast. So that's giving us an extreme reading with the RSI 9. And looking at the seasonal chart where we tend to top out in the beginning of November, and which is kind of what we were doing here, although we topped out a little bit before that. But if we stick with seasonal patterns, the VIX should continue to decline if we do stick with that. And that would mean stocks are going up because they're also in a period of positive seasonality. The momentum of the VIX continues to be down, and we went up. Now, this is a little off kilter because the bond market was closed on Monday, and then we had interest rates really going up on Tuesday. So we're seeing this fear gauge actually starting to go up and the other fear gauge continuing to go down. So we're seeing some contradiction there. A little bit of a tick up here with the equity put call ratio, but the 5-day is continuing to decline and we're below this red line, which sometimes means we're getting extreme. When we finally bottom here and start to go back up, that could produce some concern for the market. Sometimes it marks a top or at least a slowdown when this happens. And here is a longer term look at that same chart, just going back further to give it a little bit more context. 10-day average is still going down, so that tends to be positive when the equity put call ratio is going down here. And we're still below the band with the volatility risk premium. We were seeing the risk looking out into the future very high. Since the election, it has really dropped down. Advanced decline line did come down. We did not surpass this previous high based on price, where we were setting new all-time highs based on the S&P itself. We did set a high based on volume, and that could still be positive, but it did pull back in Tuesday's session. And we're seeing a little bit of a drop-off, but still a really healthy reading when we look at the new highs, but we're seeing a bit of an expansion here of the new lows. We're going down with the 5-day, but we're still going up with the 10-day moving average. And we decline, but we're still above zero with the advanced decline ratio. We're coming down a little bit with the accumulation distribution, but we're still above the moving average. This indicator right here, the boom indicator, it's not really reflecting what's really happening with the indicator now. And this is the concern, the chicken money flow. Now, it improved a little bit. We went up a bit with the histogram, but we've been really going up here with the S&P, but this is not really showing the strength. It's improving, and it looked like we were starting to turn positive, but the last few trading sessions, we pretty much have been flat with the red line, and that's a bit of a concern to us. We want to see the smart money in there buying. And we're rolling over, but still above zero with the Chaikin oscillator. So a little bit of weakness there after this has been pretty much showing us consistent strength. The vortex is still positive with the green line going up and the red line going down. A little bit of a drop off with the cumulative advanced decline line for the S&P based on price and volume, but still coming off of a new high here with volume, not surpassing it yet based on price. And seeing a little bit more of a decline here with the NYSE advanced decline line when we compare it to the S&P. The broader market was weaker than the S&P it was itself. So we're coming down, dropping below the moving average with the cumulative advanced decline line, declining but still above the moving average with the regular NYSE advanced decline line. And then the common stock saw a little bit of a drop here, also based on volume. So when we break these out based on price and volume. Here's the other advanced decline line, declining but still above the moving average. So we're holding up, and it's showing some profit taking here. Declining a little bit with the advanced decline line, but we're still above the moving averages with all of the indexes. And the stocks above their 20-day moving averages coming down a little bit, but still above 50. So this is still positive, coming down, but still above 50 with those stocks above their 50-day moving average. A bit of a decline and still positive with the 100 period moving average study and 200 period moving average study. So this is the pivot point up here, this dashed line. That seemed to provide the support of that's as low as we went based on the S&P 500. So we want to watch this level. If we break below that, that could be more negative. The fact that we're still above it remains more positive. We drop below the moving average here based on volume. And coming down with the rate of change based on 5 periods, looking back 5 periods, this will really drop because we have 1, 2, 3, 4, 5. This is still giving a high reading, but a lot lower. As these lower prices drop off the calculation, this indicator will probably drop down as well. And the 20, 50, and 200 saw a little bit of weakness, but we're still holding up fairly well there. We're coming down, but still extreme positive with the Stochk RSI, Williams percent R, CCI 14, and the CCI 20. And we're getting extreme now in all different subdivisions of the short-term time frame. Here we are with the short-term stochastic. Even though it's coming down, it's still extreme. Rolling over, but extreme in the intermediate short term. Going extreme now with the long short-term stochastic chart. Coming down and no longer extreme with the force index. We finally came down below this upper Keltner band here. The condition of the short-term trend, we are coming down. We see a red bar here because we had a down day, but we're still above both of these lines and they continue to go up. So we're still well above this area, these lines that are going up, showing that the short-term trend is still quite positive. And we're still above the simple and exponential moving averages here. And the blue line is starting to go above the red line, showing more momentum there. And we're in the +3 channel with the standard deviations chart. So we're getting rather extreme that way. Balance of power still continues to be right at about 0. It's neutral. It's not positive or negative currently. Rolling over a bit, but still extreme with the CMB composite. The 50 period trend is still looking pretty solid, still above the red line and the blue line, and the red line's above the blue line. So that's showing good momentum for the intermediate term. Still positive with the go, no go with the dark blue bars. Still looking pretty solid here with the highest high value. TTM squeeze continues to go up, so that's still looking more positive. And this is the standard deviation going back 10 periods. It's a really high reading because it's picking up that pretty big gap that we saw right after the election. Still positive with the ease of movement. We're above 0. This is where we're seeing a little bit of a concern. We're dropping below 0 with the McClellan oscillator for the S&P, and so that's ever so slightly starting to turn the summation index down based on price, and we're starting to go down based on volume. This is a concern to us. Is this the start of something or just an anomaly of a rest period before the market gets set to go higher? We're also below zero with the NYSE McClellan oscillator. Really hard to see, but starting to tick down with the summation index based on price and volume. This is the Arun, where it had been really extreme, and then we didn't have that big of a down day, but look at how selling just really picked up here, and buying is dropping off. So we are dropping down, but we're still above zero with the oscillator when we compare the green line with the red line. Coming down a little bit, but still positive with the Swenlin trading oscillator based on price and volume. Is this part of a warning sign too? But the momentum is still positive. The PMO is positive, crossing above the moving average based on price, still just not quite getting above the moving average based on volume. So coming down a little bit, but still looking positive with the PMOs that are rising, flattening after rising with the buy signals, flattening to slightly going down now with the PMOs above zero. But the momentum still looking good in the short term with the slope oscillator. The MACD is still positive. All of our oscillators are positive. Still showing some improvement with the TRIX and KST, our long-term oscillators, but we're just trying to get above the moving average with the TRIX. We're not quite there with the KST. The Copic curve, another momentum oscillator, is still positive. We're still positive with the ultimate oscillator, and we're positive with the money flow. We're still above the moving average with on-balance volume, and not quite really extreme with the Sean trend meter, dropping down just slightly, but still extreme. And the percent beat finally dropped down here. We're finally below the upper Bollinger Band now. We've been keeping an eye on that one. And rolling over a bit with the RSI 14, and now we're starting to drop down. This is an official overbought signal in the short term with the RSI 9. When it goes up and rolls over and then drops back down below 60, that's the official signal. But we're still positive with the Elder's Impulse system for the S&P. The parabolic SAR is still positive. We're still above all the plotted moving averages. Coming down, but still kind of far away from the 20-period moving average as well as the 50-period moving average here with the boom indicator. And kind of stalling a little bit, but the bullish percent index for the most part is continuing to go up, even though it did go down a bit on Tuesday. And still going up here with the NYSE bullish percent index. And after being extreme with the NASDAQ 100 bullish percent index, we are coming back down slightly. So it's no longer extreme. And really no areas of support or resistance because we're still dealing with uncharted territory for the most part. We look at the condition of the trends here by the Heiken Ashi, we are still positive here. We're positive with the Kagi chart, we're positive with the Renko chart, and we're positive with the three-line break chart. So the trend hasn't really been threatened yet. It's just some internal things that we're seeing right now. And coming down, but still above the red line with our 150 and 200 period moving average study here. Still positive across the board with the Keller market model. Still negative in the short and intermediate term with bonds based on price. Commodities are negative across the board, and the dollar has been quite strong lately, positive in the short and intermediate term. So we saw communication, tech, and staples. Now, communication, that's a growth area. So is tech. So they were up slightly, and that's kind of what held the market together. Staples is a more defensive area, but it really wasn't up all that much. Where we saw discretionary, which has really been doing well lately, saw some profit taking there. Healthcare, defensive area, and materials ended up being the weakest. And utilities were down on more than 1%. So not really seeing much of a change here when we compare the S&P weighted index with the equal weight version. That's the equal weight is the red line. The Dow came down right to this R2 pivot level. So we're seeing another pivot point that is acting as support. We saw one, this is really crazy with volume here. We saw that with the S&P. Now we're also seeing it with the Dow. We've gone from positive to neutral with the Elder's Impulse system for the diamonds. Also coming down, we dropped a little bit below this pivot point, but we were able to close back above it for the NASDAQ. And the same thing here. We dropped down below this R2 pivot point with the NASDAQ 100, but we're able to get back above that. We've gone from positive to neutral with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive. Small caps, of course, they were screaming to the moon, had to give a 1.5% of that back. We'll see Is this what we're going to see now? Because we see a real nice upthrust and then a lot of give back. Is this just a pit stop before we get set to go higher, or are we going to see more weakness with the small caps? But they were looking pretty extreme here with the RSI. It's finally dropping down below 70 when we look at the Russell 2000 small caps. Still looking really solid here, just looking at the bar charts, and the momentum continues to be positive. We've gone from positive to neutral with the small caps with the Elder's Impulse system. Mid caps also coming down off of setting a new all-time high. Didn't get down to this pivot point yet. We'll be watching that if there's more weakness here. Also switching from positive to neutral with the Elder's Impulse system for the mid caps. And coming off of setting a recent all-time high with the Wilshire 5000, a broad market measure, also coming down 0.45% with the total U.S. stock ETF. We're keeping an eye on this because we're seeing the S&P doing well. We're seeing a little bit of weakness with the home builders ETF, and the correlation is weakening. Now, we haven't dropped below this dashed line yet. If we continue to fall, that could cause us some concern. Financial sector was down slightly after setting an all-time high. The FANG index did set an all-time high. It's actually breaking out from the July highs that we saw here. Had been holding up, but kind of underperforming over the last few sessions. It was up 0.73%, but we're still below this shorter term trend line. It would be even more positive if we could get above that and close above that trend line there. Apple was unchanged. You don't see that very often. Where Amazon was up 1%. We had Microsoft up 1.2% and still dangling around the 50 and 200-day moving averages. Still hasn't generated a death cross yet. Google was up 0.7%. Meta was up 0.28%. And this is how the market kind of held up here with these stocks not doing great, but not doing terrible. We had Nvidia up over 2%. Tesla, some folks decided to take some profits, and that's why it was down 6.15%, but still looking pretty good there. Netflix setting another new all-time high, 1.75% of an advance there. And still seeing more of a disconnect when we compare U.S. stocks with world stocks in the short term and in the long term. Oil just kind of bouncing around, not really going up, not really going down, kind of fluctuating between that high 60s and low 70s. And the dollar just continues to be on a tear here. We're getting up into the 105 range, almost into the 106 range. And we saw a real big move up with the 10-year yield. After it had been declining, now it's starting to go back up. So we're going down with the 10-year based on price. And then looking at the growth to value ratios here, a little bit of weakness, but still above the moving average with Qs to S&P. A little bit of a pullback with discretionary to the S&P. Seeing things still looking better here when we compare large cap growth to large cap value. So the large caps, mid caps, and small caps really improving with the growth to value ratios. So what's the outlook then for Wednesday? We're still positive, and we do have this period of positive seasonality, and I do have the daily chart. I finally got that from the Stock Traders Almanac, folks. But we're still looking rather overextended in the short term, which could suggest good momentum. Maybe we've seen enough of a rest over the last couple of sessions. If CPI comes in and the market likes that, we could continue to go to the upside. And we're still wondering, is FOMO still in the air, the fear of missing out, or is that pretty much past now? We're going to get the MBNA Mortgage Applications Index. We get that every week. CPI is going to be the big one. And then the geopolitical things going on in the world here. We're going to get PPI on Thursday, retail sales on Friday. Those will be the biggest ones there. Here's a look at what the forecasts and previous readings were here for Wednesday and for the rest of the week. Seasonality now. We are in options expiration week, and we tend to be up more than down. But for November 13th, we're positive with the Dow and NASDAQ. We're neutral to positive with the S&P. And here's the daily chart here, where we might see a little bit of positive seasonality here for the 9th trading day of the month, but it can get a little choppy. And then as we work our way through November, this is where we see a little bit more weakness going into about the 20th. And Wednesday in 2023 was the most negative day of the week, but it's more positive in 2024, at least to this point. And then Tom Bowley's research. where according to him, we're still in this area of looking a little bit more positive, but we're going to be hitting an area where we tend to be more negative. And as I keep saying, we as soon as this week is finished, you'll stop seeing this chart because I'm going to run out of these lines to highlight here. The blackout period for stocks that can do, or companies that can do buybacks, is really dropping off now. But looking seasonally with the Carson chart, we do see positive seasonality going forward. Also positive seasonality after the election with this chart and the next chart as well. So what are our warning signs? We have a confirmed Hindenburg Omen. In yesterday's video, this was the only negative thing. Now we're concerned about the McClellan oscillators for the S&P and NYSE, which are then turning the summation indexes negative. We'll see if that's starting something or if it's just a little bit of weakness before they turn back positive. And then our list is still pretty positive here. Accumulation distribution, we're still above the moving average. We are concerned about the Chaikin money flow. It's just not showing a lot of strength right now. The Chaikin oscillator turned down, but it has been pretty strong lately. The vortex is positive. We're still holding up when we look at large cap growth to value. Discretionary to staples, still looking pretty solid there. The 5 and 10-day equity put call ratio charts are still going down. The advanced decline line saw some weakness, but still holding up for right now. The 20, 50, 100, and 200 period moving average studies showing some weakness, but positive. The parabolic SAR, the Swenlin trading oscillator, the bullish percent indexes for the S&P, NASDAQ 100, and NYSE, those are all positive. We're still looking positive with our oscillators and the Copic curve. We haven't quite switched with the long-term oscillators. The ease of movement, money flow, and ultimate oscillator continue to be positive, and the financial sector is positive as well as the momentum for the NASDAQ 100. So our conclusion, I haven't changed anything here. We still are positive with positive seasonality, wondering if we're overbought in the short term and wondering if the fear of missing out is still going to be a factor. We're possibly still looking overbought, even though we've worked off some of that in the short term, but we're still positive with that. We're positive in the intermediate term, still have kind of a long list of extreme indicators, with a few of them actually showing some weakness, and we're still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.